And then we saw something magical happen. I mean, if you go back, as far as you want to go back, actually, you will not see a chart like this. It goes crash, 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 crash. Everybody's running away, run away, run away. And suddenly the White House says, oh, now's a good time to buy. And, 10 minutes later, boom, away it goes. This is where we are, where markets are, at best, you can say highly curated, manipulated, or definitely held are instruments of policy now, rather than free markets that trade on the basis of the market's pricing of it.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials while supplies last. First this week we feature 10-ounce silver Royal Mint coins at just $2.99 over spot per ounce. The 10-ounce Britannia, 10-ounce Royal Arms, 10-ounce Little John, and 10-ounce Merlin are all 4.9s fine, and we have a very limited quantity. Again, they're just $2.99 over spot per ounce while supplies last. Next, backdated 1-ounce gold Canadian maples are only $69.99 over spot. And finally, backdated 1/10-ounce Platinum UK Britannia are just $29 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Clem Chambers, the founder of anewfn.com. Link in the description there. Clem, thank you so much for joining us today.
Great to be here.
Well, it's great to have you today. I did want to discuss the tariffs and also supply chain issues we might be seeing soon. We did just see a new deal between U.S. and China, kind of holding off on the tariffs there. Your perspective on that new news, and also, do you think it'll? I've heard that the trade between U.S. and China has been really strained, and we could see supply chain issues soon. Do you think this new deal will kind of hold that off, or your perspective on where we are right now?
Well, there is already a problem in the supply chain. So it's 75 days long. We're now sort of like 35, 45 days with the supply chain in a very strange setup. I mean, what is in the supply chain? How much of it is in the supply chain? And it's going to be, not very full. So that's coming. It's like it's coming down the pipe. Or not coming down the pipe in this case. Now, whether, as of yesterday, everybody decided to start, refreshing their orders and say, get those nuts and bolts, on a ship now. Or whether they're going, hang on a minute, 90 days, or hang on a minute, 30%. But it's not actually 30%, it's more. I mean, the thing that amuses me to such an extent that I don't even want to say the number. What exactly is American tariffs right now? And obviously, it has been changed from yesterday. But it's not just 30%, because there's already an amount of tariffs. And not being an economist with spreadsheets of, the current tariffs on this is that, the current tariffs on that is this, plus 30%, it was 124%. So it's just gone from a embargo to high tariffs. And, certain people are saying that, actually, this is just America getting VAT. And these tariffs are just a way of the American government to tax consumption. So it's a sales tax by stealth. And that may or may not be a great thing. And so really nobody really knows. And you can't know because it's only a 90-day hiatus to what's going to happen next. And what is going to happen next? It looks like there's a whole load of 180s coming out of the White House. Which are claimed not to be. And if there's bad news, it's the previous government's fault. And if there's good news, they did it. So it's really pretty much chaos. And chaos is a strategy. Don't think that it can't be a strategy and that it isn't a strategy. Crazy as a fox is a strategy. Or in this case, as crazy as a hippopotamus. Because, America is this huge, powerful beast. And it's gone random. And, that is the... isn't that the ploy? Isn't that this part of the strategy? You don't know what you're dealing with here. Just give us what we want. And What does that do to the markets? Well, we saw what it does to the markets, and then we saw something magical happen. I mean, if you go back the last 10 years, as far as you want to go back, actually, you will not see a chart like this. It goes crash, 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 crash. Everybody's running away, run away, run away. And suddenly the White House says, oh, now's a good time to buy. And, 10 minutes later, boom, away it goes. Well, it could be a coincidence, that, couldn't it? Or not. It could just be what the government does, which is provide liquidity in times of trouble. And of course, hey, here comes a wave of liquidity, a massive wave of liquidity coming out of the Treasury. They've got a checking account, and when things get sticky, they draw down from that checking account and flush it into the system, into the financial system, and up goes assets, because people get a free play, basically. They get to play with the house's money in a no-lose situation. So they go, yay, and they buy, and up it goes. And I think that's what you've seen. And that money's gone everywhere. I mean, you can't just keep it into your country. So it's whooshed into the UK and whooshed into Europe. If you look at the FTSE 100 chart, it ain't seen nothing like that. And it's not just because, the White House is full of geniuses. It's because somebody pulled the big lever that said, support the market. The so-called Fed put, well, it's not a Fed put. I believe it's probably a Treasury put. And they pulled the lever and they've juiced up money supply in a way where people can't really see it. But you can see it in the chart. I mean, and then, of course, when there's too much money, it goes into crypto, up goes Bitcoin, because that's the frothy one. That'll be the last one to play that game with free money. So I think that's what you've seen. So the question is now, how sustainable is that? Now, the bad news is that should be inflationary. The good news is inflation is down now. It's kind of back to where it was. So, the Fed, with years of slow, diligent screwing the screw down, putting the genie back into the bottle, getting the cat back into the bag, has got it back into the bag, give or take. So there is plenty of room to do the opposite, to pump it back in again, like at COVID. You could say this is a national emergency. I mean, they've said it's a national emergency, haven't they? I mean, they've actually called it something like that. So, a little bit of national emergency inflation, well, it's called for, isn't it? But where does that put you as an investor? It puts you in a very, very awkward position, because if that sort of thing isn't sustainable, if in 90 days' time everything doesn't go to plan, if, Europe does turn out to be this beast that they are on and off being called, and people get fed up with it outside of America, buying, there's so much that can go wrong. What in the past, the way that governments work, particularly America, is they try to make things stable. They do everything that they can to stabilize anybody, everything, everywhere. So if there's a bit of a trouble around the corner, look, please stop that. And look, you need some money? Oh, it's a euro crisis, is it? We'll give you some money to tide you over. Yeah, we'll swap lines, da. So American leadership has been to make the world a stable place and to elevate everybody. That has been the strategy of America since 1944. Well, pretty much, probably before that, you could say. But, that's the post-war American strategy. Rule the world by proxy, sort everybody out, make them dependent on you by, being the armed forces, and, walk quietly and carry a big stick. Well, the change of policy now is to walk loudly and wave a big stick at everybody. And that's a new world. And how do you invest in that new world? I have pivoted. I mean, I saw it coming, so I got out. So I'm a clever boy. I didn't see that part of it. No. That's unprecedented. Crashes are common. And I think I've studied all of them for many, many years. Crashes don't make V-shaped bottoms. There was one kind of in COVID, a little bit of a down and kind of straight back up again, but they normally go down. Oh, make a recovery because they've gone down too much. Oh, go back there. Everybody's exhausted and scared. Oh, crawl back. Yeah, it makes a nice W bottom. V bottom is very rare, right? Because it means something disastrous happened and somebody stepped in and fixed it. Oh no, phew, that's a relief. Very rare. And this is the second one almost in history. Yeah, and it's totally unprecedented. So what do you make of it? I make of it as more scary times ahead. So I'm all in blooming precious metals, which it's not my favorite thing. Let's just put it that way. Hardly any equities. I've got some which are so crazily contrarian and beaten down that, they can't really go, they're good companies, can't really go down anymore, although they can. I'm just sat there. So right now, I avoided a 25% haircut on my portfolio, which I'll tell you, that would have made me cry. The blooming thing's back to where it started from. And I'm up because I'm, up on the old gold and a few random punts that I did. And I'm where I was before it all kicked off. And it's just weird. And weird is dangerous. And, you've got to understand what is driving this. If there's something to understand, you see, because the crazy like a fox strategy is all about not being predictable. It's being unpredictable. And the other side that may outnumber you, that may be stronger than you, getting a bit scared because there must be something else going on here that we don't see. They must have an army over the hill that we don't know about. They must have got some kind of trap that we're about to fall into. So, that unnerving element is what actually makes that a game theory strategy. So here we are, and I'm kind of hedged in as much as good news will help things like platinum and palladium because they are industrial metals and they are beaten down like you wouldn't believe. And, if the industrial miracle that is being predicted happens, they'll be in great demand and they'll go through the roof and I'll be very happy. But that's not my natural environment. My natural environment is to be, really, really long, completely long in nice equities, lovely, lovely, cuddly equities. And I might even leverage up my capital base to be in these nice, cuddly, friendly equities that, are good businesses and they do things and they're kind of predictable. And that's a very comfortable place to be. But we are in very uncomfortable times. And I think there's just a lot of intervention going on. And who knows how sustainable that is. And at the end of the day, intervention makes it a unnatural price. And at some point, you can't keep intervening. Maybe you don't need to. So as the intervention goes off, so the price starts going down. And if you look at that chart, you'll go, that's amazing. It's going to go up forever and it's brilliant. And moon. I just see the beginning of a very long bear market as a potential of a very long bear market. So we will see. Because at some point, hopefully, the market will say, right, we understand what's going on. The volatility shrinks. So you stop doing this and it goes less and less and less and less and less and less because the market is comfortable, knows where it's at. They've plumbed the depths of the political drama that we're in. And it says, right, we're going that way slowly, or we're going that way slowly, or we're going that way slowly. And when that volatility dies off, which it will very shortly, the direction it then goes in will define whether you're in a bull or bear market. And I just got a feeling that we're going to be in a bear. The thing is, the long-term trend is the thing that you jump on. Yeah. If you're just trading in and out and you don't know, it's going to go up today, it's going to go up this week, it's going to go down this week. I've just pulled that out of my ear. You're going to actually lose money on the basis of being right half the time, wrong half the time, and losing your commission on your cost of trading. Okay. And that will bleed you to death over the long term. So what you need to know is which way the direction of the market is. And, historically, buy the dip is all about you're in a bull market forever. We're in a bull market. It's a modern world. Everybody's, everything's under control. Everybody's elevating, new technology, wonderful, wonderful, wonderful. And it's always going to go up. So it doesn't matter if it goes down, it's going to go up. Doesn't matter if it's going to go up. Yeah. You're always in a bull. But the difference between a bull market and a bear market, and you won't find this in any books, this is my sort of stuff, and I shouldn't give you all my secrets, is that a bull market tends to flow up and it has these corrections or crashes. It goes bang, and then it drifts up. And it will do that. And you can see that shape since the 1980s. In fact, you could probably take it back as far as you like. Yeah, it's that sawtooth. Flow up, sharp down. Imagine a saw, the way that the blade runs, it goes up, down, up. And that's a bull. It can be a polite ball, it can be a steep ball, it can be even going down a little bit because of something occurred. But nonetheless, the dips are sharp and the rises are slow. Yeah. And over time, that means you're going from here to here. Yeah. In that float crash. A bear market does exactly the opposite. It floats down and it goes bang. It floats down, it goes bang. Yeah, well, we kind of just went bang, didn't we? So, we'll see. We'll see which market we're in. This year, we should know whether this is all, 7D chess and it's all brilliant and it's all good. Oh, it's sustainable to interact with the market forever like that. Or that we are actually in a bear. And that bear, if we are in one, which I think there's a good chance, is going to be a long one. It's going to be a long one, so it's going to be quite difficult to be in equities in that scenario. But we will see. We will see. It's literally, we now are in a situation where if I was to say what happened, if you look at the chart, you've got the crash, you've got, okay, we're going to have to be a little bit less full of ourselves about what we're doing. You notice how the volume of wild claims has kind of come down somewhat. I mean, what happened to Doge? By Mr. Musk, the guy that started it with Musk, went out the door within days of going through the door. He went, hello, remember, we're going to, right, and now Musk is gone and that's all gone quiet. So that was a very good way of getting your public sector under control and getting your fiscal deficit down and controlling the blob and all that stuff. Yeah, but the blob is mighty. The swamp is a mighty swamp, and they've got their tendrils in absolutely everything and everywhere and everybody. And you go in and cut $1 trillion out of your public spending, that is very deflationary. That is very, that's going to be that's $1 trillion that's not going down the McDonald's, that's not going into the shops, that's not buying new cars, etc., etc., etc. So that's a real drag on your economy. Well, maybe that's kind of, not what it was. No longer going to be a 2 trillion, no longer going to be 1 trillion. It's now going to be a couple of 100 billion. And, you can print that and push that in the market and give it to your mates or whatever, or just let it go out through other pipelines. So that risk has definitely been shrunk. The tariff thing, wasn't it all going to be fixed? Wasn't it all going to be, now it's another 90 days? Oh, now it's a rando number, which may or may not be the number it is. So the outcome's gone like that. So, but tariffs, tariffs at 30% with China, the history of tariffs is not a happy one. And a 30% basal increase on your inputs on however much of your raw materials you're dealing with is going to multiply. Because, if your 6-inch nail is another 30% more, the builder who buys that nail, he marks that up 100%. That 30% is going to be 60. And then the guy who's selling the builder, he's going to mark it up 100%. So now it's 30, 60, 120. I mean, when the price goes up as it comes through the door, it gets marked up by the guy that wholesales it or distributes it. And then the wholesaler marks it up. He doesn't say it's $1 more, I'm going to make it $1 more to my customer. He goes, my margin needs to be 50%. It's $2 now. And then it's $4 and then it's $8. So that input is going to, if we're going to be dealing with 30, 20, these big tariff numbers, it is going to be a big inflator. So, that will come through the pipe and maybe people won't notice it because it will take the year or two to come through. And in the past, it just means that international trade stops. I mean, the thing with the drugs is a very, very, very interesting dynamic, that one. And again, if you're a drug company, but what just happened to your stock price? Not a lot, it appears. Really? Okay. So, yeah, you can buy the fat jab in the UK for $200. Not $90, $200. I mean, it depends where you go, I suppose, but, that's what it costs me. And it is $1,400 in America. And that is an issue. But if you say, right, you've got to sell your drug to us at the cheapest rate that you sell it to everybody else, you put your prices up elsewhere, don't you? People in Africa don't get their drug anymore because it's just gone up 500 times. So the level of unintended consequences that these kind of extreme policies create are unknown unknowns. Because nobody knows. They go, oh, I've run on a computer. We know exactly what it's going to do. Politics, we are the masters of this game. Couldn't possibly go wrong. What could possibly go wrong with such a policy? And yes, let's make Alcatraz a prison now. I mean, where did that come from? If you take that and blow that out, your risk profile just gets really wide. And the riskier something is in markets for assets, your assets go down. So outside of intervention, if the intervention goes away, the market will reprice this increase of risk, systemic risk, to the whole system. And that will pull prices down. And so it's hard. Is anybody out there feeling bullish? Apart from on things to run away and hide in like gold? I mean, maybe they are. I mean, once upon a time there was a free market, and then we had the credit crisis, the global financial crisis, and the economists and the central bankers got it by the scruff of the neck. And then we had COVID, and they were really busy, and we got inflation because you would in that circumstance. And now, this is where we are, where markets are at best, you could say, highly curated, manipulated, or definitely held are instruments of policy now, rather than free markets that trade on the basis of the market's pricing of it. And that makes for very, very, very difficult times for the investor, for the normal investor.
It is difficult, and I think even to manipulate as well. I think the market is difficult, but when we see these moves that we've seen over the last month or so, a month ago we saw the Dow up 2,000 points, as you mentioned, kind of that V-shaped bottom, and then just yesterday, we're recording this May 13th, so yesterday we saw, the Dow up 1,000 points or so. So you're saying that is kind of the manipulation full view. It doesn't have to do necessarily. There are stories along with it, right? When the Dow went up 2,000 points, it was because tariffs were paused 90 days. And then yesterday, the deal between the U.S. and China. But you think there's something else going on, that it's actually the U.S. Treasury or some government agency manipulating the market?
Said on another podcast a few weeks ago when it was started to go up, I said, well, according to the market, it's all fine. These tariffs are not going to happen. Well, who would know that? Yeah. And, when somebody says it's a good time to buy stocks and within an hour or two they go through the roof, either that person has remarkable timing or he knows something's coming down the line, and they're not going to just sit there and let the market crash. And they have plenty of tools to save. You see, if the market reprices, that's not a problem. But if you get somebody cries fire in the opera house and everybody heads for the door, there'll be disaster. So what regulators do is they go, right, well, we won't let there be a systemic failure. We don't want this situation to cause a domino effect where all the dominoes go down, like in 29, like they nearly did in the credit crisis in 2007, 8, 9. Yeah, you step in and you make sure that those dominoes don't fall. And they did the same thing in COVID, right? You just don't let there be a systemic disaster, because if things go too far and there's panic, that panic actually burns the place down, and then you have to, you are in a lot worse place than if you just stepped in and bailed out people. Everybody gets a bailout, yeah, and that bailout then comes out the system as inflation in this case, and everyone goes, oh, where's this inflation coming from? Well, you got a bailout. No, it didn't. Yes, you did. Yes, you did. The economy didn't collapse. Why do you think it didn't collapse? Well, those Fed people, they were being silly and they did all that stuff. It's all their fault we got inflation. You see, it's all their fault you didn't have an economic collapse as well. But you can't not end up paying for it. And the best way to pay for these sort of things is through inflation. And that's how governments pay for these things. That's why places in South America have 40% inflation, because they're constantly bailing out and having wild ideas how to, make their economy better. They're constantly having handouts to various people to keep them sweet, etc. And all that money supply comes out into the system as inflation. And so what you're seeing now is a low inflational result from, several years after COVID of squeezing all that money out of the system. And I think you're seeing some of it getting put back in. And the classic way that would be done in this particular manner would be for the Treasury to use its checking account to force liquidity, not force, but push liquidity into the financial markets. And people in the financial markets, it's basically you get a phone call and it says, Elijah, how would you like to have 100 million? Here's a trade. It's going to be good for you. I'll lend it to you for next to nothing. You can put on this basis trade and make 9%. You're going to say, thanks for the money, guys. I mean, if you short the S&P 500 future and you long the S&P 500 cash, that's a 9% or so gap over the year. So as the time goes by and you get a decay, you're going to make 9% of your money guaranteed. But you've got to be able to borrow it. Yeah. At I don't know, you don't care really, do you? 5% is fine, as long as you can get your hands on it. But, it's like, can I borrow some money for your 5%? I only want 10 billion to short the S&P and long the S&P. And they go, no, it's not around at the moment, mate. We just don't have any. We don't have it. Or we don't trust you. Or we've got no need to push that money into the system because we're not going to do it. And then they get a phone call from the Treasury saying, hey, here's some liquidity. And they ring the guy back. That money you wanted to buy and sell the S&P 500? We've got it. When do you want it? Yeah. And that's how liquidity supports and pulls the plug on markets. Yeah. If you've got hot inflation and inflation's running hot, I ring up, say, I want to borrow some money for the S&P 500, blah, blah, blah. They say, leave it at 9%. Oh, well, I can only make 9% at it. Well, do you want it or not? Well, no, I don't actually. Can you give it to me at 5? No. We haven't got it at 5 because the government's just pulled the liquidity out and interest rates have gone up and we can't afford to lend it to you at that rate anymore. So you can't afford to do a basis trade. You remember back last year when Japan put their interest rates up and the markets nearly collapsed because everyone went, oh no, all my clever basis trades, my carry trades, they're all now loss-making, or they'll put it up again and they will be loss-making. I better get out now before they do it. And then everybody rushes for the exit and everything goes down. And the central banks come out and say, have some money. No, don't worry about that. No, we won't do that. Oh, calm down, everybody. And all of a sudden it goes, oh, they're not going to let that happen. Up it goes again. And that's the sort of thing that regulators have been doing for a long time, but been doing it before the accident rather than after the accident. They call the ambulance before the accident occurs. Yeah, and they get in the way of what would be a systemic situation. And that is, I'm sure that's what we've just seen. And so we had the accident and they went, oh, interest rates going through the roof. Oh, we might have wrecked our bond market. Oh, stock market has dropped 20%. Okay, what are we going to do? Oh, we're going to do this. Okay. And you're going to say, oh, it's all going to be fine now. And we're going to pull the lever and up it goes. But of course, you're storing up trouble for the future, aren't you? Because it's not a free market. So you get a distorted market, and the more distorted the market is, the more inefficient your allocation of capital becomes, and you get into all sorts of long-term issues. And is fundamentally it sustainable? And how sustainable is it? And so that's the big question. Now is how sustainable is this situation? And do they have the firepower to make all these dramatic changes in the way that America's economy is meant to be working? And I say it will be a lumpy, bumpy ride.
How sustainable do you think this is when we look at the market manipulation and, the government lending liquidity or, flushing liquidity back into the system? How sustainable is that? And what is your outlook going forward? It sounds like, if I'm hearing you right in your first answer, you are expecting a continued bear market. So this manipulation will fail in the long run.
It always does. It always fails in the end, but it can go on a long time because it pops out in other places. Yeah. So it pops out this manipulation has popped out in the fact that normal people find it hard to buy real estate anymore. Right? They can't buy real estate anymore because all that money that was pumped in created inflation in certain asset areas. I mean, QE, everyone said, oh, you do this QE, we're going to get a huge inflation. Oh, no, don't do that. And then it didn't. And everyone went, oh, we don't understand why it isn't putting up prices at the supermarket as much as it should be. Well, it put prices up at the real estate agent a lot more than expected. It put prices up in the stock market a lot more than expected. But of course, that's a kind of inflation, most people like that because they've got stocks and they've got real estate, apart from the poor people that don't have either and now can't afford any of it. So you get this built-in systemic problem, and it grows and it grows and it grows and it grows and it grows. Okay, so that is the problem with tampering with the market. Now, the good news is that maybe you create a higher equilibrium point, which is overall better for everybody. Because you imagine if the American stock market wasn't as incredibly highly valued as it was today, if it was valued like the UK stock market, America would be bankrupt. I mean, it wouldn't have $50 trillion in market cap companies. It would have 10. And then what? It'd still have its debt. So the previous system of curating the market has pushed a large quantity of American value assets into the stock market. So that's where all the value lives. And you end up with your farmland owned by the Chinese and all these other things, all your assets, lots of other assets being owned by people outside because of all your deficits. But the actual value is collecting into the Nvidias of this world, and that may or may not be sustainable. But you can't keep pushing it up in real terms forever, because then you get into a sort of bubble like Japan did when the Emperor's Palace was worth more than all the real estate in California. And you can't sustain that. That is unsustainable, and it comes crashing down. And then you get 25 years of economic difficulty. So, the beauty of the market is that it sets a pretty sustainable equilibrium. But if you then come in and you basically corner the market corners, they're very hard to sustain, and people are always tempted to make them. And the history is full of market corners. I mean, you could see this as being a market corner. And I suppose the people that get away with it, they never make the headlines. But there's certainly, over the years, huge quantities of things that have occurred because of that kind of behavior. I mean, the whole credit crisis was caused by that. They had this wonderful virtuous circle, and they just cranked it till it became unsustainable, and kept on cranking it until it became very unsustainable. And they kept on going until the whole thing imploded. And, that is what causes financial disaster. And I don't think we're far down that line at the moment, but we are in a completely different era. And so, to expect things to remain like they've been for the last 10 years, which have been wonderful. Anybody that bought equities in the US and just sat on them has been showered with money. And, long may that have continued. Will it continue? I mean, there's whether you think it's right or wrong, whether you think he's going to do it or not do it, this is a new era, and it has a new set of value parameters. And I think that, it's all changed, isn't it? And I can't see it being good. The history of high tariffs is not a good thing. And if your people are now paying a lot more for their stuff because of this input tax that you put upon them, they're poorer, aren't they? How does that make them richer?
Well, Clem, I really appreciate your time today. It seems like it'll be interesting markets going forward here, so they'll be able to follow you. I know you contribute to Forbes. We'll also put anewfn.com in the description of this video. Tell us a bit about what they'll find there.
Well, I mean, I write all this stuff down, and I'm not a doomster generally, and I'm still not a doomster. I'm just going, this is unprecedented, and therefore, really, there's a huge money in working out what is going to happen going forward. There's no doubt about it. If you can divine what's going to come out of the White House in the next 3 years, you'll make big money. And if you think it's going to be the same as it's been in the previous 12 years, I think you're going to have a rough time of it. So that is the role of people like me, or my role is to say this is what I think it is, and it's your viewer's position to listen to it and go, he's completely mad. He's completely mad. I don't know what he's talking about. He's an idiot. Or, I hadn't thought of that. Oh, yeah? Oh, okay. But this is going to happen, and it's going to go up. So, I'm just raw material for people to think about, what their financial future is. So if you did what I have done, I got out before this blooming thing blew up. And then I rotated into safe havens of precious metals because of the various other things. And that's where I'm sat. And I'm sat here going, oh, I haven't lost any money doing this. But boy, I got part one absolutely 100% right. I got part two absolutely wrong. I would have, if you said, is that going to happen? And I've wrote some pieces. And I said, if you're a buy and holder, just do what comes naturally to you. And you're just going to buy and hold, and this is going to go away, and you're going to be laughing about it in a year's time. I wasn't expecting it in 3 weeks' time that they'd be laughing about it. But, if you've got an investment strategy, you're in good shape. If you haven't got one, it's a dangerous time, a particularly dangerous time. So you need to get one, and you need to listen to all the different people and make a synthesis of what you hear based on where you are at, and you'll do fine if you do that. And I'm not going to be. I was 100% right, so I didn't lose any money. I was 100% wrong, so I didn't make a huge amount. I could have made 30% of my portfolio in 3 weeks by just getting in at the bottom, and I didn't, and I wouldn't even now. I absolutely adore Intel. I love Intel. I should have more Intel than anybody. I should buy the bloody company. But I'm not going anywhere near that market. I'm just not going to go anywhere near it because it says, warning, Will Robinson, no, run away. So even though I absolutely love that particular company, I just can't play in this sandbox until I have that epiphany that says, this is where you are. At the moment, I go 60-40, we're entering a long-term bear. 60-40, 40% could be going up, could be marvelous. But you have to trade what you see. You have to watch it do what it does and go, what did it do that? And I look at what's gone by and I see unprecedented recovery. Nothing like it ever. Ever, ever, ever. So something special happened. Now, special, that doesn't fill my heart with joy. I don't think that's a game I want to play particularly. Oh, it's very special. So, I think I'm quite happy with my position. I'd be happy just to be completely in cash and just wait for 4 years, frankly, because one has to protect one's capital. Protecting one's capital is, job one. And then, in making more capital is job two. So my position is, this is unprecedented. I've got my capital. Thank you very much. Inflation is not so high as it might be. What I think could happen is pretty frightening. What could go right? What went right could happen, but I can't imagine it. But things will change. So at some point, I will go super bullish. And whether it's tomorrow or 6 months' time or 4 years' time, I'll go, here we go. We're at the bottom, all in, boys. Pull the lever. We're going. And that is really what an investor needs to do, is to be able to evaluate the situation and tack accordingly and manage their risk. And my risk is I've got a big hedge on, precious metals for safety, for industrial development, for AI implications, for environmental necessities that are coming up. So I'm kind of in this, as you would expect, a really lopsided, uncomfortable, undiversified position, based on a wild, crazy moment where you can't be diversified. You can't have a broad spread. You can't really. You have to take almost a trading position on it, and I don't like that. I'm an investor. I just want to be sat there. Oh yes, my 40 stocks went up 0.5% today. Oh, that's nice. Tomorrow may be the same, but that's not the times we live in anymore. So I think precious metals might take a little bit of a pause, but long term, over the next 2 or 3 years, I think they will be a solid place to have a part of your diversified portfolio, more towards that. So managing your risk is really the name of the game at the moment.
Well, Clem, again, we really appreciate your time today, as always. We'll put a link into your website in the description of this video. Thank you so much for your time, and God bless.
Thanks for having me on again, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials while supplies last. First this week, we feature 10-ounce silver Royal Mint coins at just $2.99 over spot per ounce. The 10-ounce Britannia, 10-ounce Royal Arms, 10-ounce Little John, and 10-ounce Merlin are all 4.9s fine, and we have a very limited quantity. Again, they're just $2.99 over spot per ounce while supplies last. Next, backdated 1-ounce gold Canadian maples are only $69.99 over spot. And finally, backdated 1/10-ounce Platinum UK Britannia are just $29 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.